Welcome everyone to FX Street. It is 2 p.m. Eastern on a Wednesday, June 20th, 2012. Welcome back, one and all. Great that you could join us. My name is Adam Rosen. Very happy to be here. Very special thanks to FX Street. Dow Jones Industrial Average down about 1 point. The S&P down 1 point. NASDAQ 3. As the Federal Reserve is now meeting following their interest rate decision just a little while ago. Now the Federal Reserve, and we're going to try to keep track of these numbers as close as possible. There's a lot of data that we have to go through. Okay. Federal Reserve met as scheduled at 12:30 p.m. Eastern. What happens is they meet at 12:30, they announce their interest rate decision. 2 p.m. they have a press conference. This is what we're looking at now. It's a press conference that will include all of the details about the meeting. Now, they left interest rates unchanged at 0 to 0.25%. They said, okay, we're gonna keep rates low through 2014. That was as expected. No change there, no surprise. The big question today was what the Federal Reserve would do in terms of Operation Twist, and which is the current round of stimulus. See, over the past couple of years, in order to stimulate the economy, the Federal Reserve has enacted quantitative easing 1, quantitative easing 2. Both involve printing dollars to buy long-term treasuries. When you buy the treasuries, the long-term treasuries, the bond price goes down, the bond price goes up, the yield goes down. They do this to incentivize people to get back into the economy, get back into the market, go out there and buy a house or buy a car, any big-ticket item that is sensitive to interest rates. So when we buy a house, we want the interest rates to be as low as possible. So that's why with quantitative easing 1 and 2, that reduced interest rates. Unfortunately, what it also did, the unintended consequences, was that quantitative easing weakened the dollar because they printed so many additional dollars to buy these long-term treasuries, more dollars in circulation. Each individual dollar has less buying power, therefore it dilutes it, it weakens it. So then we had Operation Twist. Operation Twist is a little bit different than quantitative easing, and that started sometime late last year. And it was supposed to conclude June of 2012, this month. This was the big day that we've been waiting for, to figure out if the Federal Reserve would continue Operation Twist or would end it. The difference between Operation Twist, quantitative easing, very simply, quantitative easing prints dollars, creates new dollars out of thin air to buy bonds. Operation Twist, instead of printing dollars, they sell short-term securities. They sell the short-term bonds. Okay, so quantitative easing equals printing dollars out of thin air, really. I mean, they're making dollars that didn't exist. Printing dollars to buy long-term bonds. Okay? Operation Twist, sell short-term maturity bonds to buy long-term maturity bonds. Okay, specifically, what they're doing is they're selling all bonds with maturities up to, I believe it's 3 years. So a 1-year bond, 2-year bond, 3-year bond, they're selling. They're buying bonds with maturities of 6 years to 30 years. Now what this does is long-term interest rates go down. That's their intention. Short-term interest rates go up. Because when you sell the short-term bonds, so the bond price goes down, more sellers and buyers, then the yields go in the opposite direction. The yields go up. That's what they're doing. I don't particularly like this because it's not very helpful to the banking sector. And if you ask anybody, they would say, well, one of the big issues in the U.S. economy is the housing market. We need people to get back in there and to buy homes. There's a lot of homes underwater, which means that people own more than the house is worth. We have to, with a market, think of any stock that's going down, down, down. Most people who bought that stock are losing money. You need to wait for that event where everybody, all of a sudden, the stock changes hands. And the new owners of the stock start to make money. That's how markets reverse. Think about it. You have a stock that's $100 a share, and it goes down to 90, into 80, into 70, and people are buying it all the way down. They buy it at 90, they buy it at 80, buy it at 70. Now the stock goes at 30. Every single person that bought that stock at $90 a share or 80 or 70 or anything higher than 30, they're basically paralyzed. If they haven't sold already, now that short-term trade turned into a long-term investment. If you bought stock at 90 and now it's 30, it's very, very difficult to take the loss on that. What a lot of investors do is they say, I'll just hold on to it. I'm going to forget about it. One of these days it'll come back. The stock market generally goes up. But what does that do to the market? That means the sellers, the people who want to sell, they don't really want to sell. Or the people that are losing money, they don't really want to sell. So, only have half the market out there that would potentially want to buy or potentially want to do any kind of transaction. The sellers really don't want to sell. So the stock becomes stuck. And then when the stock starts to go up, it goes from 30 back to 40. We have those individuals that bought at 40 that said, okay, great, now I'm breaking even, get me out. And that creates a little bit of a ceiling. And then the stock can't go up any higher. And if the stock is able to go to 50 or 60 or 70, you have more sellers waiting up there. Think of Facebook. Those of us that bought it at 35 or whatever, $43 a share, now Facebook, 30, 31. Most people that bought Facebook have just said, you know what, I'm just leaving it alone. But if an event occurs where all of a sudden all those people that bought it at 90 and 80 and 70, whatever stock, then they say, you know what, forget about it. I'm getting out of the position altogether. Everybody new that buys it is now has a very good chance to all of a sudden make money. Because if you bought the stock at 90 a year ago, well, that means you're probably stuck with the loss right now because it's lower. I'm just talking about any stock, just a fictitious stock. But if if someone else that bought it at 90 sells it and then I buy it today at 30, tomorrow if it goes to 31, I start to make money. In other words, the point I'm trying to make is the market needs to wash out the sellers. In the housing market, you have so many people that bought a house for $400,000, now it's worth $300,000. Those home buyers, especially a house, they're living in the house. So they're not likely to move. They're definitely not likely to sell if they're going to take a huge loss on it. So they say, let's wait for it to come back. We need so many new buyers to come in that when the housing market goes up, a lot of people start to make money, not just waiting for all those that lost to get back to break even. Operation Twist is not very good for the housing market because the banks, you ever wonder why the banks really don't want to lend money anymore? It's not only because they're very scared of foreclosures. I mean, the market's come down a lot. If you haven't foreclosed already in a house, I would say the chances are not as much as, in the past couple of years. But the banks aren't incentivized to really lend because what are they getting? On the 10-year bond, they're getting, 30-year bond, they're getting 2.74%. That used to be 4 or 5%. Now it's less than 3. The 10-year bond yield is 1.65%, and that feels like a lot right now. 165, analysts said we would never go below 2. This really is, Operation Twist is an action from the Fed that focuses on treasuries. Now, let's take a step back for a second. The Federal Reserve, I'm going to show you a different page here. Okay, so FOMC, go to Google here, find FOMC projections. Here's FOMC projections, all right. This is what we're looking at. I'll give everyone the link. Okay. All right, this is from April 25th. Okay. This is from April 25th. At the beginning of the year, let me show you the page as well. At the beginning of the year, the Federal Reserve came out with a number of projections. They said, well, we want to raise interest rates, but we have to wait for the economy to hit certain benchmarks. And in January, they released a number of projections. So if you look under the January column, 2012, GDP, gross domestic product. Okay? GDP, in January, the Fed said it should be anywhere from 2.2 to 2.7%, right? And then in April, they said, well, the economy, it really looks good. We're going to revise that. GDP now, it's believed, should be between 2.4 to 2.9%. Okay? What was the latest reading? GDP, 1.9%. So you can see what happened. In January, the Federal Reserve said we think the economy should trade between 2.2 to 2.7% gross domestic product. In April, they said we think the economy is stronger, 2.4 to 2.9. Last GDP figure was actually 1.9%. Now, just today, the Federal Reserve met, and I'm reading from the news tape here, so forgive me if I start to stutter. Today, the Federal Reserve said GDP sees U.S. GDP of 1.9 to 2.4%. 1.9, 2.4% in 2012. Is that any different? In April, it's at 2.4. So now they've reduced their expectations. Very, very interesting. The Fed sees U.S. GDP at 1.9 to 2.4%. Does everybody follow? And if the GDP is higher than expected, that means that the economy's good. Maybe no more need for stimulus, no more need for quantitative easing or operation twist, and maybe we should start to consider higher interest rates. Conversely, if the news is bad, which it was today, the Federal Reserve said, well, that's bad enough that we need quantitative easing, because quantitative easing is a very, very extreme type of stimulus. We're literally printing new dollars, creating new dollars out of nowhere to buy long-term bonds. I mean, imagine the two of us are playing, or not two of us, but many of us are playing a Monopoly game together. Everyone knows how to play Monopoly. And we each get a certain amount of money, and we take, we go around the board and we buy and sell property trying to, create the best real estate portfolio. Well, imagine if all of a sudden one player in that game is given from somebody else extra money for nothing. Two things are going to happen. First of all, that person's going to have an unfair advantage, that they have extra money to go out there and they don't need to adhere to any kind of budget. They can buy and sell however monopoly, pieces that they want. On the other side, the prices for all of those little pieces of property on the monopoly board are naturally going to go up as well, because now there's not a collective $1,000 to compete with all the different properties. Now there's a collective $1,500. Just more money means prices naturally go up. More money leads to inflation. But what the Federal Reserve, I think, is trying to do is trying to force inflation. Inflation does not occur because the Fed wants it to. Inflation occurs because people get back to work. Consumers start to consume. Producers, therefore, have to produce more. More demand than supply, prices naturally rise. Inflation doesn't occur because the Federal Reserve interjects more money into the system to force inflation to go up. That's GDP. The Federal Reserve also measures the unemployment rates. Okay, and obviously a higher number is worse because we want the unemployment rate to go down. Okay, so in January, the Federal Reserve said unemployment should be between 8.2 to 8.5%. In April is when they revised these indications, these figures. April, they said the economy is better than expected. We did not know how good things were. So let's reduce the unemployment expectation, meaning better than expected. And now we believe the economy is so strong that at the end of this year, we should be between 7.8 to 8.0%. The last reading, latest unemployment was 8.2%, right? 8.2%. As of today, the Federal Reserve met, they revised their projections. Today's revised projections. Fed sees unemployment rate 8.0 to 8.2%, 8.2% in 2012. Well, that goes without saying. It's all the same. So what happened? Unemployment rate, the Federal Reserve in January said we want to see between 8.2 to 8.5. April, things got better. Federal Reserve said things are so good, we think unemployment will now be between 7.8 to 8.0. Well, what happened? Unemployment, unfortunately, went in the opposite direction. Went back up to 8.2 last month. First Friday of the month is non-farm payroll, unemployment number. Today's revised projections, things don't look so good anymore, 8.0 to 8.2%. The third component, so far unemployment and GDP both tell us in January they were conservative. April, they were really optimistic. After April, the numbers started to get bad again, and now they're pessimistic or more, less optimistic. Personal consumption expenditure is the last component of our measurements. PCE. PCE, personal consumption expenditure, is a very complicated way of saying CPI, Consumer Price Index. Measures a basket of goods and services on the consumer level. Now, it's a little bit different than the CPI because the CPI takes into consideration, a regular basket of goods and services that represents the U.S. consumer. A loaf of bread, a cell phone, car tire, whatever. PCE, the difference is, I'm not 100% I have this right, but from what I understand, PCE, the difference between PCE and CPI is PCE allows in for substitution. Meaning that if we go out there and we go to a nice restaurant and we get a steak dinner, the steak dinner is $100. The next month, I lose my job, I lose all my money, I still want to go out and have a steak dinner, but instead of going to the fancy restaurant, I go to the less fancy restaurant. So instead of paying $100, I paid $50. Now, I think according to the CPI, basically, the CPI will say, well, that person is eating steak dinner and they're spending a little bit less money on the steak dinner. That means that the price of steaks went down, which is not necessarily the case because the price of steaks didn't go down. Me as a consumer, I just look for the substitution. Now, one of these days when I have more time, I'll really do an in-depth study at the difference between PCE and CPI. But for simple terms, to keep it simple, think of PCE as inflation. We want that number to go up because it shows us that prices are rising and people are creating businesses. Things are good. With a PCE and core PCE. Core PCE does not include or excludes food and fuel, which are considered more volatile components of the market. So if you see a healthy economy, you'll see the PCE rise. But if you see a really healthy economy, you want to see the core PCE rise because when the price of food and fuel goes up, that's not necessarily a good thing. But when the price of everything else goes up, meaning we're making more money, but it does not cost us more to fill the car full of gas, it does not cost more at the supermarkets, that's a good sign. So we really want to see the core PCE go up. If that goes up with the standard PCE, okay. But the core really should perform well. That's what we want to see. Okay, so the PCE in January, the Fed projected that it would be 1.4 to 1.8%, 1.4 to 1.8. I won't mention the core PCE. Well, actually I can. 1.8%. We'll say the core like this. 1.4, 1.5 to 1.8. There's very little difference to 1.8. Okay. In April, the Federal Reserve said, you know what? We think we're a lot more optimistic now. April PCE should have been, they said, 1.9 at the 2.0. Core. All of this is very, very important. I know this probably can be a little bit tedious, but it really is important. Core PCE, 1.8 to 2.0. Okay. Now, Federal Reserve projections released just a short time ago. Wow. Okay. Fed sees inflation 1.2 to 1.7. That is low. Projections of 1.2, 1.7, core 1.7, 2.0, 1.7, 2.0. Oh, and by the way, the latest PCE, which was released just last GDP number, right around there. It was released, if I remember correctly, I have actually a chart here. I believe it was 1.8%. 1.8 or 1.9. I can check on that while I'm rambling on. I'm pretty sure it was 1.8, 1.9. But taking a look back at the PCE now, in January they said 1.4 to 1.8. In April they said, no, things are going to be better, 1.9 to 2.0. And now they brought the projections all the way down to 1.2 to 1.7. It's very suspicious to me how they've really brought those expectations down so much. Oh, I have my data over here. Okay, so that's certainly very, very suspicious with me because, I don't know, to say that you've missed it by a little bit, that's one thing. We're talking about missing a lot. Yeah, I'm double checking over here. Core PCE and standard PCE last month was 1.8%. They've brought the projections down so much. In fact, if you look at it, now the projections are below the last reading, which is really, you could take that either of two ways. Either the Fed is, and I have my own conspiracy theories about this, but either the Fed is really nervous about things getting very, very bad, or they, I don't know, maybe out of embarrassment, or I don't know what the motivation would be, but they don't want to be wrong. Let's put it this way, okay? The GDP number in January, they said 2.2 to 2.7. And my conspiracy theory is this. There's a little bit of a conspiracy theory. The Federal Reserve, maybe for whatever political reasons, regardless of the reasons, the Fed doesn't want to look wrong. They want the economy to improve. Now, if the economy can't improve so fast, and there's other reasons why I think that is the case, but if the economy doesn't improve, at least to create the illusion that something is happening, and to justify as much stimulus as the economy can possibly stomach. Because if you think about it, without Operation Twist, without quantitative easing, the stock market would not be so high. We put together a number of articles over here that showed how much the gains have been in the Dow during those times of stimulus. And when you take away the stimulus, the Dow Jones Industrial Average over the past 3 years, I'm talking about going back to the lows of 2009, actually did not go up very much. In fact, according to a calculation that I did, if you were to take all of the performance of the Dow Jones Industrial Average during those periods of time from 2009 through, it was the beginning of May when I did this calculation, May 1st, I believe. So if you go back to see where the Dow was in the beginning of May, all of that time that we were under some sort of stimulus, either quantitative easing 1 or quantitative easing 2 or Operation Twist, the Dow averaged very, very well. We were up 40% here, 20% there, forget what the numbers were. But if you take all that away, if you were only to look at the performance of the Dow Jones Industrial Average outside of stimulus, when stimulus was not being applied, the stock market actually went down since the lows of 2009. Now, if you remember the lows of 2009, here I'll show you a picture of the chart. Here's the chart, I should say. 2009, the Dow Jones Industrial Average was at 6,000. Now, we all trade Forex, so we have to put this into currency terms as well. And then what we're going to do is try to make an educated guess as far as what's most likely to happen in the future. During quantitative easing, and we have a lot of different charts, maybe I have them here. Okay, I have other charts to show you. But during during periods of time with quantitative easing, we know that's good for stocks because stocks like low interest rates. Low interest rates make it more affordable to buy a house, to buy a car, to buy a refrigerator, any type of large transaction. So corporations tend to like quantitative easing and Operation Twist because it's putting money into the market. It's putting money into the economy. In the case of quantitative easing, it's free money. It didn't come from anywhere else. Now, as far as the dollar is concerned, the dollar actually goes down a lot during quantitative easing because remember, when you're printing more money, and this is a risk, that a lot of analysts believe that this could be the beginning. Operation Twist was, by the way, extended today through the end of the year. Now, quantitative easing tends to send the dollar down because it puts that many more dollars into circulation, and therefore we buy commodities to hedge our falling dollars, and that's why gold went up so much and oil went up so much, which in turn is the reason why nobody wants any more quantitative easing because it dilutes the dollar too much, sends oil up too much, sends the PCE, not the core PCE, but the personal consumption expenditure sends that number up. That's not good. So here where we stand now, I'll tell you my conspiracy theory, then we'll take a look forward. My conspiracy theory is that maybe for some political reason, the Federal Reserve or the powers that be, leave it at that, they said we really want to enact another round of stimulus. Why? Because that's going to be good for the stock market, and that'll give the economy a boost. And maybe that'll be good for us, come next election time. Now, but even if you take away that last element, forget the political side of this. If the only motivation of the Federal Reserve was just to improve the economy, they want more stimulus. They want to create more stimulus because stimulus is good it's not necessarily good for the economy, but it makes the numbers go up. I don't think it's necessarily improving the unemployment rate. It's not necessarily improving the GDP number. But what it is doing is it's sending stocks higher. When stocks go up, we have more buying power, we're more optimistic, and maybe in turn we use some of those profits from the stock market to buy a house or buy an iPad or, consume. And, maybe the economy improves that way. I think that's what the Fed is hoping. But the Federal Reserve, in my opinion, I don't think they should try to motivate the stock market one way or the other. Stock market will go up when it reflects a strong economy. Not because the Federal Reserve is, going out there and buying so many long-term bonds. They're trying to dissuade people from buying bonds. They don't want traders to buy bonds and to hide in savings accounts. The reason why we can't earn any interest in a savings account anymore is because the Federal Reserve doesn't want us to. They want us to go out there and buy stocks and invest in mergers and acquisitions and buy a house and get the economy back on track. It's kind of a weird way of going about it if you think about it, but I think that's what they're doing. But getting back to the evidence of my conspiracy theory, take GDP, gross domestic product. In January, the Fed said we expect 2.2 to 2.7. In April, they said, well, let's look forward. May, June. Okay, 2 months after April, they knew quantitative easing was scheduled to conclude. So they said on June 20th, we're going to meet, and we're going to have to decide what to do with interest rates, and we're going to have to decide what to do with Operation Twist. And as of right now, we told everybody, the Federal Reserve told everybody, Operation Twist ends in June. It was supposed to end today. That was the plan. Federal Reserve says, well, what can we do to justify a continuation of stimulus? Well, we say they might have said, and I haven't heard this anywhere. This is my own weird conspiracy theory about it. But I think the Federal Reserve in part maybe said, well, you know what? We need a good reason to give the economy more stimulus because stimulus is good. So let's raise our expectations. It's like a student going to school, and as he walks out the door going to school, he says, Mom, Dad, I'm going to get straight A's. I'm going to get an A+ today. GDP is not 2.2 to 2.7%, like I said it was in January. I'm now saying it's going to be GDP. I expect to be so good in April, 2.2 to 2.4 to 2.9%. They raised their expectations of GDP in April, I think, because they knew that was going to be a very hard bar to match, a very hard level to reach. and that we're probably going to disappoint. And because now we saw those numbers disappointed, now we have further justification to create more stimulus. In this case, extend Operation Twist through the end of the year. Does everybody follow? Unemployment rate. In January, they said, we think it's going to be between 8.2 to 8.5%. But for some reason in April, and I've looked at the numbers and I honestly can't figure out what it is that they're looking at. The unemployment rate in April, they said, would be now 7.8 to 8.0. At the time, it was 8.1. They said it was 8.2 to 8.5, went down to 8.1, and in April they said, no, things are so good, it should be 7.8 to 8.0. Well, after that, the latest unemployment level is actually 8.2%. It's kind of weird how they would expect the unemployment rate really to continue to drop down to 7.8% in the summertime, which typically, it's not really considered a time that we see a lot of hiring, right? Summer jobs, part-time jobs, but things slow down in the summer. Well, today they revised the projections. They said, you know what, things are not as good as we thought they were in April. Projections back up 8.0 to 8.2%. PCE, personal consumption expenditure, this is the best example. In January, they said it's 1.4 to 1.8. This is inflation. In April, said, inflation is so high, so good, that it's going to go up to 1.9 to 2.0. Well, it actually came out at 1.8, so it came in below expectations, and now they reduced their projections all the way down to 1.2 to 1.7. But notice something, and this, I guess, was the point I'm trying to make about 3 days ago. But notice, GDP, the last number was 1.9. Today, they revised their expectations from 1.9 to 2.4. So they revised their expectations basically around the last number, to straddle the number. The unemployment rate, the last unemployment rate was 8.2, and today they revised the projections to 8.0 to 8.2. So again, they revised the projections around the last unemployment level. But what I find very interesting is that the last PCE, personal consumption expenditure, was 1.8%. And the core was also 1.8. Now, today, they revised the projections down below last month. They said basically last month's inflation numbers, they're not bad enough. We think they're going to get worse. We think that PCE is going to go down to 1.2 to 1.7%. So I follow that. I find that very, very interesting. I find it very, basically they're saying that I've read through the statement, but I haven't gone through it with a fine-tooth comb yet. But looking at just the math of these projections, they're the most pessimistic in terms of prices. Unemployment rate may not move that much, but then again, the unemployment rate, it's very hard because, as more people drop out of the workforce, the unemployment rate actually goes down because it's counting less people. So it's a very imperfect calculation. GDP, GDP they expect, where do they expect GDP to be? 1.9 to 2.4, which is, we're at 1.9 now. So they don't expect GDP, but they do expect prices to fall a lot more. Now, take a look at this. This is really interesting. This is happening simultaneously. Take a look at this chart. Okay, I'll give everyone the link as well. This is the VIX, the volatility index. What this does, and I'll show you in the chart here, this measures the price of options, the price and the premium of options on the S&P 500. When stocks go up, people are optimistic. They don't need options to hedge their portfolios. All they very simply do is buy stocks and hold them. Stocks go up. It's easy. When stocks go down, traders tend to buy options. They buy protective puts or they sell covered calls. They increase their participation in the options market. And as that additional activity in the options market occurs, premiums rise. So the VIX is a fear, which is also known as a fear index, basically shows how much extra traders are paying on premiums for options for the protection. In other words, when the stock market goes up, the VIX goes down. When the stock market goes down, the VIX goes up. What happened 2 days ago was a VIX, for the first time in a while, fell back below 20. We're looking at two extreme levels, by the way. With the VIX 15 is very, very low, and 40 is very, very high. Typically, when the VIX hits 15, we want to sell stocks because when the VIX hits 15, it means the market's so optimistic that probably stocks are going to go up, and that's usually the best time actually to sell. When the VIX hits 40, it means there's so much fear in the market, it's actually a good time to buy stocks. The VIX dropped back below 20, which is a benchmark that a lot of traders watch. Specifically, the VIX dropped back below 20 on which was the first time that the VIX was below 20 since May 15th. May 11th. The VIX had been above 20 since May 11th. Well, take a look at, this is the chart of the Dow Jones Industrial Average, May 11th. Notice what has happened. As the VIX has crossed back below 20, the Dow Jones Industrial Average has come all the way back to the levels we were at, roughly 12,800. May 11th, the intersection of these two lines. In other words, when the Dow went down, 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 the VIX went up. The VIX has come all the way back down, the Dow has come all the way back up. That's interesting. Now, compare that to the euro dollar, which we will look at here. This is May 11th. The euro dollar at the time was 129. Let me refresh the chart. I want to make sure everybody can see this okay. The euro dollar on May 11th was 129. The euro dollar right now is below 127. And we were significantly lower earlier. And it really looks like the euro dollar struggling to break above this 127.50 level, including today's highs. Notice the divergence? Why is it that the VIX, that broke below 20 for the first time since May 11th, was able to come back all the way back down? Let me show you the VIX again. Again, here's the VIX. We were below 20 on May 11th. That was the last time we were below 20. We went all the way up when the stock market sold off. We came all the way back down. Now we're back below. We've returned all the way back down. The Dow Jones Industrial Average in the same time, May 11th, came all the way back up. That means if you bought the Dow on May 11th, if you shorted the VIX on May 11th, you would now once again have a little bit of profit. If you bought the Dow, you would over here on May 11th and went all the way down. All this was a losing trade. Now we're basically breaking even again. You're breaking even on the Dow. You're breaking even on the VIX. What you're not breaking even on is the euro dollar. If you bought the euro dollar same day, 120 on May 11th, euro dollar came down, you'd still be losing 200 to 300 pips on the euro dollar. Meaning the euro dollar does not want to go up as high. Now, what's the correlation between the dollar and between the euro dollar and the Dow Jones Industrial Average? Very simply, one of the big reasons why stocks have been under so much pressure is the debt contagion crisis out of Europe, and the fact that the dollar is considered the safe haven of capital, and that if we're afraid that Greece could default and Spain could follow, we're shorting the euro and we're getting out of stocks. And as stocks go down, the VIX goes up. Now, the fear after the Greek elections has passed a little bit over the past couple of days, and that's actually not really true. The reason why the stock market's been so strong lately and the forex market's recovered so much over the past couple of days is the anticipation of stimulus, quantitative easing, or in today's case, Operation Twist. Now, the euro dollar did not come all the way back up. What does that mean? That means I think there's damage that has been done to the euro dollar. The euro dollar is well below its May 11th lows, May 11th levels. The Dow is not. The Dow came all the way back. The Dow is stronger than the euro. That divergence shows us that if I'm going to short something, I think the euro goes down faster than the Dow does. Also, when stocks go down, capital tends to move into the low-yielding currency, which in this case is the dollar. The only thing that hurts the dollar is stimulus. Stimulus is like sugar. It tastes good, but it's really bad for our teeth. Same way that the dollar does not like stimulus. You print more dollars and to stimulate the economy, and well, those dollars actually lose value. Now, that's one thing. The other thing that I find very interesting is this. And remember, the entire center of this entire Operation Twist effort is done through the Treasury market. On May 11th, the 10-year bond yield closed at 183.76. May 11th. I should have been typing all this in. Okay. 10-year bond yield, 1.86%. Now, 10-year bond yield, 1.63%. Bond yields, of course, go in the opposite direction of bond prices. Federal Reserve, Operation Twist, are buying more bonds. The bond price will go up. They expect the bond yield to go down. They want the bond yield to go down. But notice the same divergence occurs here as well. Stock market has come all the way back up to the May 11th levels. The bond yields have not. The VIX has. So if you think about it this way, the stock markets, this is actually very interesting. The stock market is optimistic. The VIX, which measures the price of options on the stock market, well, S&P 500 or the Dow, it's more or less the same. They parallel each other. The VIX is also equally as optimistic. What is not optimistic is the euro dollar. Things have gotten worse in terms of that currency. And things have gotten worse in the U.S. market as well. You see, I don't think it's only a euro issue. The reason why the euro dollar is not stronger is not only because of the euro, it's also because of the dollar. If the dollar has been so strong, it has prevented the euro dollar currency pair from going up. The dollar has been so strong, yet bond yields are down. Bond prices still continue to go up. Question is, since there's no clear sign of quantitative easing 3, what does this mean to asset markets? Well, this is $1,000 or the $1 million question, right? If we look at history, quantitative easing has been good for stocks. Quantitative easing has been, well, let's put it this way. Not quantitative easing, it's Operation Twist. What effect did Operation Twist have to the stock markets? I actually have this article, by the way, was also published on FX Street. I don't have FX Street's link, but if anybody there happens to know what I'm talking about, and it was, I'll tell you the date. It was the Fed's projections. I put together an article that specifically discusses this. As soon as I find, I'll tell you the date, because there's another copy of this article through FX Street as well. Looking for my first Fed's projections article that I wrote. Seems like ages ago. I think this is it. Yes. Beautiful. This, by the way, May 8th. Is it May 8th? Yeah, May 8th. Okay, let me show you this chart. Quantitative easing 1, the Dow Jones Industrial Average, after touching lows of near 6,000. In the early days of 2009, March of 2009, that was the ultimate low after the crash in 2008. Quantitative easing 1, during quantitative easing 1, it's not only because of quantitative easing 1, but it was a very large contributing factor. During QE1, the Dow went from 6,000 and change all the way up to over 11,000. QE1 ended, the Fed took their foot off the gas pedal in the stock market. The Dow crashed. Not crashed, but went down fast. 11,000 went down to 9,500. Fed says QE2. By that time, the Dow would come back to 11,000, maybe in anticipation of QE2. Remember, the market's a forward-looking mechanism. So I was always trying to guess the next step. Your question is a very good question. We're all asking the same question. How will the markets behave? QE2, quantitative easing back on the table, stock market did very well. QE2 ends, and that coincides with that very sharp sell-off we saw last summer, last August, that a lot of us attribute to the debt ceiling contagion crisis that turned into the losing the AAA credit rating in the U.S. and, a lot of other things that were going on at that time, the political infighting, etc. But a lot of that moved to the downside. It went down a lot. The Dow last summer was a result of QE2 ending. Operation Twist, the Dow was at lows of 10,400, and obviously we know where it went. It went up to 13,400. So Operation Twist has been good for stocks. But if you measure the percentage moves, there's actually a deteriorating, I did the math at one point. I can't remember where I put that piece of paper, but there's a deteriorating effect, meaning the Dow the first time under quantitative easing 1 basically doubled, almost doubled. QE2, we went from 11,000 or 10.9 to 12.3. We went to maybe 30%. And then the last Operation Twist, 11,000 or 10,400 to 13,000, we went up as well, but we went up a little bit less as well. Now, my gut tells me to trade with the trend, and anytime we have additional rounds of Operation Twist or whatever it may be, historically that's been good for stocks, but it's been less good than it was in the past. And maybe it's the conspiracy theories out there, but something tells me that I would not be surprised if stocks don't react as favorably, but the textbook answer, the way the markets have reacted so far, has been that stocks go up with more Operation Twist, with more stimulus. I'm very, very suspicious of that happening. I'm actually bearish. But if you ignore my opinion, just look and see how the market reacted, stocks went up. Why would the market go up during Operation Twist if there's no new money being added like quantitative easing? Because it's a great question. The difference between quantitative easing and Operation Twist is just where do we get the money from? Quantitative easing, someone walks into your house that you've never seen before and they give you free money. They give you extra money. Here's extra money. Go out and buy a car or do whatever you want. It's your money. Operation Twist, well, we don't get the free money, but what we do get is we get additional money by selling something else. We're buying long-term bonds, but to do so, instead of printing money, we're selling short-term bonds, which means, think about it this way. You don't have to pay your car insurance anymore, and you don't have to pay your home insurance anymore and your fire insurance anymore. Use that extra money to go out and buy a new car. Now, if you just look at it on the surface, you have a new car. You have new clothes. That's great. You have extra money in the bank. But if you look at internally, we're selling the short-term bonds. And I don't mean to equate short-term bonds to any sort of insurance policy. But my point being is, you don't get something for nothing. You're selling the short-term bonds. Well, the Federal Reserve, in a way, is now committed for a longer amount of maturity. And there's different risks associated with holding longer-term bonds as well. But the cap, that money, wherever it comes from, either from printing dollars or from selling short-term bonds, that same amount of money is being brought back into the store, meaning our economy, and it's being used to buy long-term bonds. You buy long-term bonds, long-term interest rates go down. 30-year mortgages now at 3.75%. Bank called me the other day. They offered to refinance me at 3.75%. Unbelievable. Never seen before, never seen again kind of long-term mortgage interest rates. That's what the Fed wants. The Fed wants the bank to reduce rates so much that it would be silly not to buy a house if we could. Take a look at the New York Treasury bond yield quantitative easing 1. They're buying the long-term bonds. Bond price goes up, the yield goes down. But remember, this is a push and pull because as we add QE1, the stock market went up a lot. When the stock market goes up, the bond market goes up because the bond market says, hey, everybody's buying stocks. We have to offer those investors a choice. We have to offer them higher yields. So the bond yields really do want to go up, but quantitative easing is pushing them down. Quantitative easing is telling everybody, don't pay attention to the bonds. Buy stocks, buy stocks, buy stocks. Don't worry about the bonds. Buy a company, merger acquisition, put your money out there in the market, buy a new car, spend, do something, consume. Don't worry about the bonds. Bonds are for safety. QE1 ended, stocks went down, and all of a sudden everybody said, oh, we really do want the safety. We were silly not to buy the bonds. And the bond yields crashed as the bond price went up. QE2, same as QE1. Operation Twist, notice the difference here. Bond yields went down a lot to incentivize people to get back involved. Getting to Forex, and obviously if you look at gold, I'm running out of time here, so I don't want to use my time unwisely here. Dollar Swiss is what I'm looking for. Quantitative easing one was very bad for the dollar. Quantitative easing one, the dollar Swiss fell from 121 down to parity, below parity, 2,000 pips. Why? Because they're printing all those new dollars under quantitative easing. Each dollar is worth less. It requires more. You require more dollars via a euro or a barrel of oil or whatever it may be. Bad for the dollar. QE1 ends, dollar moves up. QE2, the Fed steps on the dollar again. It goes down further. QE2 ends. Notice this is the difference. Notice how the dollar has changed behavior. It did not go down in Operation Twist the way it went down in QE2. To go back to your first question, since there's no clear sign of QE3, what does that mean to the asset markets? Well, I don't know. I think that it could be an environment for a stronger dollar because we're not printing more dollars. Ideally, we want to see the economy improve so much that we start to anticipate higher interest rates. Then you're really going to see the dollar all of a sudden mount a huge rally to the upside. Nobody's talking about higher interest rates right now. But I think Operation Twist could be good for the dollar if it works. Aussie yen. No, there's very, very little difference. But notice how there's a deteriorating effect. QE1, Aussie yen goes through the roof. There's a weekly chart here. I think it's a weekly chart. 5,500 to 88, 3,000 pips. QE1 ends, goes down. QE2 we go up, but we don't go up as much. We only go up from 81 to 89, 700, 800 pips. QE2 is over, it goes down. Operation Twist, you go from not making new highs though. Aussie yen cannot break 90. Wouldn't we expect Aussie yen to continue to make higher highs? This is missing here. There's divergence. There's a weakening effect. Oh, here's another chart that I put together, by the way. This is really interesting. The blue line we have from left to right, we have the different asset markets. The blue line represents quantitative easing one, and then post-quantitative easing one. Quantitative easing one, this is the Dow, by the way. This is how you read it. This is the Dow on the left-hand side. QE1, post-QE1. Dow goes up a lot, almost 30%. After QE1, goes up very, very little. QE2, the Dow goes up, but goes up less. After QE2, it goes down more. Operation Twist, the Dow goes up, not as much as in QE1. We've now extended Operation Twist. But my real suspicion is that there's a deteriorating effect. It's not going to be, it's like medicine. The more medicine we take, the less effective it is. If you look away my name on FX Street, all of those articles are printed there. I don't have the exact link, but if you look under my name on FX Street, all my previous articles have been printed. Okay, so to recap, well, we have a few minutes left in case there's any questions. Federal Reserve meets as expected. They keep rates unchanged to 0 to 0.25% level, with their projections that interest rates will remain near zero through 2014. The big question was what they would do with the latest round of Operation Twist, the latest round of stimulus. They've decided to extend that Operation Twist through the end of the year. Operation Twist involves selling short-term maturity bonds to buy long-term maturity bonds to turn around and incentivize the consumer to consume and improve the economy. Operation Twist, like all rounds of stimulus, has been very good for stocks. And it has not necessarily been very bad for the dollar. It's not really, my observation is that Operation Twist has not been as effective in the Forex market either. Quantitative easing is basically like a very slow, very long intervention. What happens when the Bank of Japan intervenes? They go into the market at the weirdest possible time when none of it's expected to happen, and all at once they buy $6 trillion and sell 6 trillion yen, or the equivalent of $6 trillion in yen, forcing in one moment, forcing the dollar yen to go up. When the Swiss National Bank intervened, they were buying euros and selling Swissy. What the Federal Reserve is doing with quantitative easing is they're literally going out there and they're doing the opposite of an intervention. They're intervening on, they're printing dollars to buy bonds. They're basically intervening on the bond markets. Because what the Federal Reserve is trying to do is improve the economy internally. And the economy internally is measured by the bond market. But again, I think this is a mistake of the Fed, is that they're using, I don't know how I'd say this correctly, they're using the barometers as a tool of manipulation. Meaning, I use the bond market to monitor the markets. If the stock market's going up, the 10-year bond yield will probably go up just like it is today. It's at 1.24%. If Greek bond yields face a real fear of default, then those bond yields will go up out of a fear of risk. But I would not necessarily buy bonds to help my stock position. I don't think that, I guess the point I'm trying to make is that I think if the Federal Reserve, if they want to improve the economy, you have to improve the economy not through monetary measures, but rather through fiscal measures, which unfortunately is not under the jurisdiction of the Federal Reserve. I mean, that's a congressional issue. The corporate tax rate and, other fiscal tools, mainly taxes and regulation. Lower taxes and regulation, and the economy can start to breathe again. So I think that, but unfortunately, for whatever reason, that's not taking place. The Federal Reserve is trying to mimic, to make the economy look like it's better, and in turn, that will, or incentivize, really force investment capital into the stock markets. Because at the end of the day, every investor has a decision to make. They have a choice. Today, I have a choice. I'm going to either buy bonds, buy stocks, buy gold, buy oil, or any number of currencies or combination of it. Now, I measure the risk and reward all the time. I say, you know what, now the economy doesn't look so good. GDP was only 1.9%. The PCE has been coming down. Unemployment rate's back up to 8.2. I'm nervous. I don't want to buy stocks. I don't want to invest in a company right now. Let me just hide. Let me just stay in cash. Let me buy a safe haven like a bond. The Federal Reserve says, no. We need you to get back out there into the economy. Get back out there and buy and spend. Get this economy turned around. You want to buy bonds? Well, you can buy bonds if you want, but you're going to get no interest rates because we're going to buy all the bonds. We're sending rates too low. Now, if you want to buy a 10-year bond, you're only getting 1.63%. That's below inflation, which means if you buy a 10-year bond, you're actually losing money against inflation. If you want to put your money in the savings account and really play it safe, you're really going to lose against inflation. That's what the Federal Reserve is doing. They're forcing us, not forcing us, but they're incentivizing us to buy stocks because hopefully if enough of us, and when I say buy stocks, I also mean contribute into the economy. If most of us decide to either use our money to buy a stock or invest in a company or, have one company buy another company, mergers and acquisition, that'll get the economy, or buy a house, that'll get the economy moving again, and then things will get better. But I don't think that you can push a horse to water. What's that expression? You can lead a horse to water, but you can't force him to drink. You can lead us in the right direction, us being the investors, and say, well, you can make stocks look very attractive, and those dividend yielding stocks will look attractive because the bond yields are so low, but you can't force us to drink. If you want us to drink from the economy, then you have to create an environment that makes more sense. By the Federal Reserve increasing Operation Twist, they haven't taken any risk out of the economy. All they've done is made the alternative look a little bit worse. Question, do you think the Euro Swissy will stay flat or will the Swiss National Bank intervene? They've been intervening all along. I just read an article recently. They achieved another record. Swiss National Bank is backed against the wall. when the Euro Swissy drops below 120, which is the level that the Swiss National Bank, they drew a line in the sand. When the Euro Swissy dropped below 120, the Swissy became so expensive that no one wanted to do business in Switzerland anymore. And there was a lot of anecdotal stories I heard about people in Switzerland driving across the border to the bordering countries that use a euro currency to go to the supermarket, because food was literally so expensive if you used Swissies. But yet, if you converted your Swissies into euros, things got a lot better. The reason why this is so difficult for Switzerland is because they're an export-driven economy, and they export finance. So imagine how much your financial costs will be if you do business with a Swiss bank. An ATM charge might be $5 or €5, or it could be 5 Swiss francs. Obviously, ATM charge is a silly example, but I think you get the point. Do I think they're intervening? They've been intervening all along. There's no reason to believe that they're going to stop. In the Swiss National Bank, they don't talk a lot. So, if they say something, I think it'll be headline news. I think if all of a sudden they stop buying Swissies, or not Swissies, they stop buying euros against the Swissy, then you could see a real drastic move. I don't anticipate that'll happen soon, though. I've seen no indication that they're going to change their tune. I'm just about out of time if anybody has any questions. Here we go. Okay. Recently, there was a spike in the Euro Swissy. Do you think the Swiss National Bank tried to trigger the stocks of people waiting to break peg? I don't know. I don't know if I don't know. I'm not that. I wish I was privy to that kind of knowledge in the Forex market. I really don't know. I watched the market all day. I read the news all day. I did not see anything about rumors of a real credible rumors of a Swiss National Bank intervention or trying to run the stops. It very well could just be a number of feeds, that drive your charts and my charts. It may not even, that spike might not even have occurred under all trading platforms. But honestly, based on the Euro Swissy not moving at all, and not for a long time now, I completely ignore the currency pair. I don't think there's any reason to trade the Euro Swissy. I think you'd take a lot of risk in either direction. I think the best thing to do in the Forex market is identify the strongest trends and to trade in the same direction as those trends. I always watch the news to make sure that we have reason to believe that these trends will continue. But, our latest development today, Operation Twist, there's really no reason to believe that these trends that have been developing over the past couple of months, I don't think there's any big reason for them to change, especially because we don't have quantitative easing. With that said, I think I'm just about out of time. If you have any questions, you can contact me. I am out of time. Wow, I ran too long. You can contact me, www.forexlounge.com. I want to thank you all very much for joining us. Very special thanks to FX Street. Always a pleasure. Please see their calendar because we have a lot more ahead of us. Again, we thank you for joining us. Wish you a great day. All profitable trades. And we look forward to